Hey everyone, welcome back to Corporate Decoded, the place where we unpack the hidden stories in corporate filings. And today we are diving deep into Sonim Technologies Incorporated's recent proxy statement, a document that is usually filled with a lot of boilerplate, but sometimes hides some really interesting strategic moves and financial decisions for the company. Think of it as a peek behind the curtain of what keeps a company like Sonim running and what massive changes they might be planning. So what is this all about? Well, Sonim Technologies Incorporated is asking their shareholders to approve a few key proposals at their 2025 special meeting of stockholders, scheduled for the 16th of October 2025. It is a virtual meeting, so no fancy ballrooms here. The first big item on the agenda is a reverse stock split. Now, typically companies do this to get their stock price up. Sonim S stock has been trading below $1, and Nasdaq has listing rules that require at least $1 per S-share to stay listed. So they are asking for permission to do a reverse split anywhere from a 1-for-2 to a 1-for-30 ratio. The board will decide the exact ratio later to maximize benefits. This is a common move to avoid getting delisted and to make the stock look more attractive to investors who might shy away from penny stocks. It is a little bit of a cosmetic change, but it is crucial for maintaining that vital Nasdaq listing. Nasdaq sent them a warning because their stock price has been below $1 for 30 consecutive days, and they have until February 2026 to fix this. So this reverse split is a direct response to that, to try and get their stock price back over that dollar mark and stay on the exchange. Without this, they risk being kicked off Nasdaq, which would be pretty bad for them. Now, while this sounds like a simple fix, there are risks. For instance, they cannot guarantee that the reverse split will permanently increase the stock price, because that depends on many factors like the company, its performance, and general market conditions. Plus, even if the price goes up, they might still get delisted for not meeting other Nasdaq rules. Also, a reverse split can sometimes make it harder for smaller investors to buy or sell shares, because they might end up with odd lots, meaning less than 100 shares, which can have higher transaction costs. Then we have Proposal 2, which is an increase in the authorized shares of common stock. Right now, they are authorized to issue 100 million shares, but they want to boost that to a massive 1 billion shares. This gives them a lot more flexibility for future needs, like raising money through stock offerings or future acquisitions, without having to go back to shareholders for approval every single time. As of the 15th of September 2025, they had about 80 million shares available. If this proposal passes, they will have nearly 980 million shares available. That is a huge increase, and while it gives them options, it also means there is a potential for significant dilution for existing shareholders if they issue a lot of new shares. It is a double-edged sword, a tool for growth, but also a way to dilute ownership if not managed carefully. Proposal 3 is about increasing the number of shares available under their equity incentive plan. This plan is essentially how they grant stock options and other awards to employees and directors to incentivize them and keep them motivated. They want to add 1 million more shares to this pool. This is important for attracting and retaining talent, especially as they plan to grow their business. As of the 15th of September 2025, they only had about 44,000 shares available for new grants. This increase is necessary to continue offering competitive compensation packages. It is a standard practice, but it is worth noting that these grants do dilute existing shareholders. Looking at some historical data, the company S burn rate, which shows how quickly they use up their equity awards, was 7% in fiscal year 2024. This is a significant amount of dilution. The last proposal is an adjournment proposal. This basically allows the board to postpone the meeting if there are not enough votes to pass the first 3 proposals. It is a safety net to ensure they can gather more support for their key initiatives. Now let's quickly look at the executive compensation. For 2024, PW, the CEO, had a total compensation of about $672,000. Clay Crolius, the CFO, earned about $503,000, and Charles Betcher, the Chief Commercial Officer, made about $745,000. These numbers include salary bonuses and the grant date fair value of stock awards. When it comes to outstanding equity awards, as of the 31st of December 2024, PW had options for over 514,000 shares. Clay Crolius had options for over 108,000 shares, and Charles Betcher had options for over 100,000 shares. These are significant numbers and represent the potential for future dilution. In terms of performance for fiscal year 2024, the company had a negative net income of nearly $34 million. This is a pretty substantial loss and highlights the challenges the company is facing. The total shareholder return for the same period was about $34 for every every $100 investment, which shows a negative return over the last few years. Looking at who owns the company, Peter Liu owns about 2.85%. But the big players here are AJP Holding Company Incorporated and Orbic North America Incorporated, each owning about 11%. There are also other significant holders like CVI Investments Incorporated and One Main Capital Management Incorporated. This tells us a good chunk of the company is held by institutional investors or significant shareholders. Now let's talk about the overall picture. Sonim Technologies Incorporated is clearly in a turnaround or at least a stabilization phase. They are facing NASDAQ listing pressures and trying to boost their stock price through a reverse split. The increase in authorized shares and the equity incentive plan adjustments suggest they are planning for future growth and need the flexibility to fund it. However, the financial tables show a company that is not currently profitable with substantial net losses. The diluted shareholder return also indicates a challenging period for investors. The company S strategy relies heavily on future growth and successful execution of these new plans. The key risks here are their ability to maintain NASDAQ compliance even after the reverse split, and whether they can leverage the increased authorized shares to effectively grow the business without significantly hurting existing shareholders through dilution. The success of the equity incentive plan is also tied to their ability to attract and retain the talent needed for this growth. In conclusion, Sonim is making moves to stay afloat and prepare for potential future growth. But the financial results so far are not very encouraging. The reverse stock split and the increased authorized shares are critical steps, but the real test will be their operational performance and ability to generate profits in the coming years. So what is your take on these numbers and what they signal for the company? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.